There's a document sitting on the Resolute desk right now that most people will never read, 17 pages, signed at 12:47 p.m. Eastern Standard Time on January the 20th, 2025. And buried on page 11, in the kind of legal language that makes your eyes glaze over, is a single sentence that just made some of the smartest people in finance go very, very quiet. Executive Order 14298, Securing America's Strategic Monetary Metals. The sentence says, the United States Treasury is authorized to purchase physical silver at a price not to exceed $600 per troy ounce. $600. The spot price right now, as I'm recording this, shows $73.42. So either the President of the United States just overpaid by a factor of 8 for a shiny metal, or something much stranger is happening. And if you think this is about silver, you're looking at the wrong thing entirely. This is about what happens when a market that trades $500 billion a year suddenly discovers that most of what it's been trading doesn't actually exist. Let me show you what I mean. The COMEX is the world's largest metals exchange. If you want to buy or sell silver in any serious quantity, you do it through the COMEX. It's been operating since 1933. Trillions of dollars have flowed through it. It's as establishment as finance gets. And right now, there are 4 major banks holding short positions on the COMEX totaling 215 million ounces of silver. A short position means they've sold contracts promising to deliver physical silver to buyers on demand. That's how the market works. You sell a contract, someone buys it, and when they want their silver, you deliver it. Here's the problem. As of January 17th, the total registered inventory in all COMEX vaults, the actual physical silver available for delivery, was 18.3 million ounces. So these 4 banks have promised to deliver 215 million ounces. The exchange has 18 million ounces available. That's not a shortage. That's not a supply chain issue. That's a structural impossibility. And for decades, this didn't matter, because the vast majority of people trading silver contracts never actually asked for delivery. They just rolled their contracts forward, or settled in cash, or closed their positions before expiry. The system worked as long as everyone agreed to keep playing the paper game. Trump's executive order just changed the rules. Section 1 of the order declares silver a strategic defense critical material under the Defense Production Act of 1950. That sounds bureaucratic. It's not. Under the DPA, the government has absolute authority to seize, acquire, and control the supply of any material deemed critical to national defense. They can compel producers to sell to the government first. They can restrict exports. They can essentially nationalize the market if they choose to. Section 2 establishes something called the Strategic Silver Reserve. Initial acquisition target, 500 million ounces. Let that number sit for a second. 500 million ounces. The entire COMEX system has 18 million ounces of deliverable inventory. Trump just ordered the Treasury to acquire 27 times more silver than exists in the entire registered system. Section 3 establishes the acquisition price at $600 per ounce, but only for verified physical delivery of investment-grade bullion. Paper contracts are explicitly excluded, and that's the kill shot. Because what Trump just did, intentionally or not, is announce to every industrial buyer, every investor, every sovereign wealth fund on the planet that the United States government believes physical silver is worth 8 times the current market price and that paper contracts are worthless. Now, if you're thinking this sounds insane, you're not wrong. But here's where it gets interesting. Within 13 minutes of Trump signing that order, industrial buyers who had been sitting on the sidelines flooded the COMEX with delivery demands. 47 million ounces requested in 30 minutes. That's 2.5 times the total registered inventory. At 1:32 p.m. Eastern, the COMEX did something it has only done twice before in its entire history. They halted all silver trading. The official statement cited extraordinary market conditions requiring assessment. I spoke with someone who has access to the order book at the moment trading was frozen. They described something that shouldn't be possible in a functioning market. The bid side showed buyers willing to pay anywhere from $150 to $400 per ounce. The offer side was completely empty. Not sparse, not thin, empty, 0 sellers at any price. There was no market. There were only buyers with no one willing to sell to them. This didn't happen during the Hunt brothers squeeze in 1980 when silver hit $50 and nearly broke the system. This didn't happen during the COVID crash in 2020. This has never happened in the history of commodities trading. By 2:15 p.m., the COMEX released a second statement announcing temporary modifications to delivery procedures, which is exchange speak for we're about to invoke force majeure and cancel contracts because we physically cannot fulfill them. Meanwhile, the physical market started doing things that don't make sense if you believe the $73 spot price is real. In Shanghai, the gold exchange halted silver trading after prices rocketed past $240. In Tokyo, dealers were quoting $375 for immediate physical delivery. In Dubai, premiums exceeded $400. And in London, something genuinely historic happened. The LBMA, the London Bullion Market Association, suspended silver price benchmarking entirely. The London Fix, which has set global silver prices twice daily since 1897, 129 years of unbroken operation through 2 world wars, the Great Depression, the 2008 financial crisis, did not happen today. For the first time in over a century, there is no official London silver price. So now we have 2 numbers. The paper market says $73. The physical market says $300 to $400. Well, one of these numbers is real. The other is a ledger entry maintained by institutions that are currently discovering they don't have the metal to back it up. Let me explain what's actually happening here, because it's not really about silver. For decades, the silver market has operated on what you might call a gentleman's agreement. Banks sell paper contracts representing silver. Investors buy those contracts. Most of those investors never take delivery. They're speculating on price movements, not trying to acquire physical metal. So the banks can sell far more contracts than they have actual silver to deliver, because statistically, most contracts will settle in cash or roll forward. This works beautifully as long as the ratio between paper and physical stays within certain bounds, as long as delivery requests remain predictable, as long as everyone continues to believe that the paper price reflects the physical price. But it's a confidence game. The moment a critical mass of contract holders simultaneously demand physical delivery, the system breaks. Because the metal doesn't exist, it never did. And what Trump's executive order just did is tell every major industrial buyer, every defense contractor, every electronics manufacturer, every solar panel producer who needs silver, that the US government is willing to pay $600 an ounce for physical metal. If you're Samsung or Tesla or the Pentagon and you need silver for production and the official market is telling you it costs $73, but the US government just said it's willing to pay $600, what do? You panic and you rush to secure physical supply before everyone else figures out what's happening. Now here's where this gets genuinely dark. Those 4 banks I mentioned earlier, the ones holding 215 million ounces in short positions, at the old $73 price, that represented a liability of about $15.7 billion. Massive, but survivable for institutions of that size. At $600 per ounce, that same position represents $129 billion in losses. Deutsche Bank has a total market capitalization of about $24 billion. Their silver short position alone, if they're forced to cover at anything approaching the physical market price, could exceed their entire company value by a factor of 4 or 5. HSBC, Bank of Nova Scotia, these are not small regional banks. These are systemically important financial institutions, and they're all holding positions that have suddenly become existential threats. There's a term for this in trading. It's called a death bag. A position so large and so underwater that covering it would destroy you, but not covering it would also destroy you. You're trapped. There's no exit that doesn't end in catastrophe. And what's particularly interesting is that J.P. Morgan, historically one of the largest players in the silver market, appears to have known something was coming. Over the past 90 days, while other banks maintained their massive short positions, J.P. Morgan quietly reduced theirs. They took physical delivery of approximately 12 million ounces. They closed nearly 40% of their paper shorts. They positioned themselves on the long side. The question that should make you uncomfortable is, how did they know? So now you have banks facing $100 billion losses on positions they can't cover, and a DOJ task force with authority to investigate whether those positions were built on market manipulation. This is not a trading loss. This is an existential crisis for multiple systemically important financial institutions, happening simultaneously in a market that most people don't even know exists. At 3:45 p.m. Eastern, trading in Deutsche Bank shares was halted on the Frankfurt Stock Exchange without explanation. You don't need an explanation. The math tells you everything you need to know. Emergency conference calls were established between the Federal Reserve, the European Central Bank, and the Bank of England. Cell phones confiscated from trading desks, legal teams on standby, risk management locked in windowless rooms. And the conversation happening at the highest levels of global finance right now comes down to 3 options, all of them catastrophic. Option 1, the banks cover their positions at market prices. Multiple major banks go bankrupt. 2008 happens again, but worse, because this time the contagion starts in the commodities market and spreads outward into every sector that depends on these banks for credit and liquidity. Option 2, central banks bail them out. Taxpayers eat $100 billion in losses. Inflation explodes because you just printed that money into existence to save banks from their own recklessness. Again. Option 3, governments freeze markets and impose price controls. You save the banks, but you destroy all remaining confidence in the integrity of Western financial markets. If a commodity exchange can just cancel contracts when prices move against the big players, why would anyone trust any market? There's no good outcome here. There's only least bad. And we're about to find out which poison they choose. The global response has already begun. China just banned all silver exports effective immediately. 25% of global silver processing capacity just vanished from the market overnight. India implemented similar restrictions and authorized emergency purchases at $500 per ounce. The bond market, which is usually smarter than equity markets, knows exactly what's coming. 10-year Treasury yields spiked 47 basis points in a single session. That's the largest move since the 1987 crash. Investors are pricing in bailouts, money printing, inflation, because they understand what happens next, even if the mainstream financial media refuses to tell you. So let me walk you through what happens from here, based on how these situations typically unfold. Within 24 hours, the COMEX will likely invoke force majeure. All paper silver contracts will be forcibly cash settled at whatever price the exchange decides, probably somewhere between $100 and $150. Not the $600 the government said it would pay. Not the $300 the physical market is trading at, some arbitrary number that minimizes damage to the banks. Lawsuits will be filed within hours. Contract holders will argue they're entitled to the physical metal they purchased, or at minimum, cash settlement at the actual market price, not some artificially suppressed number chosen by the exchange. Within 72 hours, at least one major European bank will require emergency intervention. Deutsche Bank is the most likely candidate, but HSBC and Scotia aren't far behind. The ECB will face an impossible choice: the largest bailout in European history, or letting systemic contagion spread across the entire banking system. Within 1 week, physical silver will be completely unobtainable in Western markets at anything close to the official price. Dealers will have nothing to sell. Industrial users will be forced to negotiate directly with miners at prices determined by private bidding, far above the paper price. Within 30 days, we'll be living in a two-tier monetary system. The official paper price will still exist on screens, showing some number that has no relationship to reality, while the real physical market operates in a completely separate pricing structure. Now, the gap between those two numbers will tell you exactly how dead the old system is. Within 90 days, the Strategic Silver Reserve will have acquired its 50 million ounces at prices between $400 and $600, permanently establishing a new floor that can never be broken without the U.S. government itself selling, which it won't, because the entire point of the reserve is strategic stockpiling. Now, I need to be very clear about something. I'm not telling you to buy silver. I'm not giving you investment advice. I'm explaining what's happening in a market that most people don't understand, using an event that most people don't know occurred. But if you're watching this and wondering why you should care about some obscure commodity market, let me connect the dots. Silver isn't just a precious metal. It's an industrial metal. It's in your phone. It's in your car. It's in solar panels, medical devices, electronics, defense systems, semiconductors. Global industrial demand is about 1 billion ounces per year. Global mine supply is about 800 million ounces per year. The market was already tight. And now you've just injected a massive new source of demand, the U.S. government trying to acquire 500 million ounces into a market that was barely balanced to begin with. What happens to the price of everything that requires silver when the price of silver goes from $70 to $300? What happens to inflation when a critical industrial input increases 400% in a matter of weeks? What happens to manufacturing, to electronics, to green energy, when companies can't source the materials they need at any price? This isn't just about traders in New York losing money. This is about the price of everything you buy potentially spiking because a commodity you've never thought about just became unobtainable at the old price. And here's the part that should genuinely concern you. If the COMEX can invoke force majeure and cash settle contracts when prices move against the big players, what does that tell you about other markets? If the London Fix can just stop operating after 129 years because the price got uncomfortable, what does that tell you about the stability of the financial system you trust with your savings? If major banks can accumulate massive short positions in a commodity they don't have, collect premiums for years, and then get bailed out when it all explodes, what does that tell you about who the markets actually serve? The answer is uncomfortable, but you already know it. There's a reason JP Morgan reduced their position 90 days before this executive order was signed. There's a reason they took physical delivery while other banks stayed short. Either they got extraordinarily lucky with their timing, or they had information that others didn't. Section 6 of the executive order, the DOJ task force investigating price manipulation. That's not decorative language. Someone is going to have to answer questions under oath about how these positions got so large, why they weren't properly risk managed, and whether laws were broken in the process. And if you think that investigation won't uncover things that make people very uncomfortable, you haven't been paying attention to how these stories usually end. The futures market opens tomorrow morning. We'll see what happens when trading resumes. We'll see whether the COMEX follows through with force majeure, or whether they try to keep the system limping along. We'll see whether physical premiums continue to explode, or whether some kind of stability returns. But here's what we already know. A president just signed an order declaring that silver is worth $600 an ounce and that only physical metal counts. Every industrial buyer in the world just got that message. Every sovereign wealth fund just got that message. Every investor who thought the $73 price was real just got a very different signal from the US government. You can't put that back in the bottle. You can't unhear it. The information is out there now. And in markets, information moves faster than regulation, faster than bailouts, faster than press releases telling you everything is fine.